Hi everybody, Terry Duffy here from NCI. Sorry about the delay, a technical hitch. We're into webinar number 3 of the joint NCI and TABMA Australia webinars. In summary, we've finished the foundations on credit, establishing accounts, PPSR, and issues of that nature. And now we're going to go on to the more day-to-day issues with regards to operating credit. So our guest today to start off the session is Trevor Goodwin, President of the IOCM, Institute of Credit Management, and he's going to be covering off the issues of credit risk management and debtor monitoring. And when Trevor completes his 2 items, I'll come back and I'll cover the issues of things to look out for and a brief summary of credit insurance. And again, we're hoping to knock it over in about 20 minutes, and then we'll have a session for questions and answers at the end. So on your screen, you should have a chat box where you can enter your questions. So with that, I'd like to introduce Trevor Goodwin. Over to you, Trevor.
Thank you, Terry. Thank you for the opportunity to speak to you today. Credit risk management is quite a detailed subject matter, and I'll try the best as I can to give you a quick overview in 15 minutes on credit assessment, debtor monitoring, and things to look out for. So we'll get straight into it, given that we are limited with time. As an introduction, where to start? Providing credit is a critical strategy to growing a business. Having an updated credit policy and documented procedures and forms is essential. As you would know, you need to have a legally drawn up credit application document, and it's best to have it looked at by a solicitor. You should have proper drawn up guaranteed documents and very clear terms of trade, which is important in your dealings with any debtor. You should have an established credit assessment process to minimise your bad debts and fully trained staff to be able to do that credit assessment. Risk mitigation is by monitoring your customers' use of credit, and you should adjust your credit limits where you see necessary. You should communicate with your customers and your management. Always talk to your sales team, credit staff, even the people that delivery truck drivers. It's important to communicate. And where necessary, take security as a safeguard. Obviously, PPSR is a major security for retention of title these days, but guarantees are very important, and charging clauses. You should always follow the best credit risk management processes. It is crucial. The first stage, you should always be trying to identify your customer. You would be doing that from the application form to start with and through all your credit checks. But it's important to identify and make sure you have the correct legal entity. From there, you would go through your analysis and your assessment, all the information that you source to make those decisions. And from there, it's crucial to follow best credit management practices and manage and monitor your accounts. As I said earlier, communicating is very important. I'll rush through this credit assessment. So obviously, the first thing you need to know is who is your customer. Ascertain exactly the name and the type of debtor. Sole traders, partners, company, trusts, associations, cooperatives. There's a myriad of different types of legal entities, so you need to know. Trust is always an issue because you should be trading with the legal entity, which is the trustee. Make sure your credit application is fully completed and signed. It must always be signed. Make sure it has been completed in full. Then you start looking at other factors such as the age of the business, the status, make sure it's registered. If it's a company that it's not in strike-off action or even wind-up action against it. You look at the size of the share capital and the paid capital. Who are the directors and company's officers? How long have they been with the company? What other companies are they involved with? Are they companies that may have fell over or having problems? Are they experienced? Find out trade dealings with other suppliers with trade references where you can. Undertake appropriate credit checks to check for adverse data. use your Equifax, Dun & Bradstreet's, NCI, of course. So do your credit checks. Look at the credit ratings, the credit score on these credit reports. If the score is poor, obviously that is a concern. Where possible, look at what their projects are, their work in progress, what previous jobs have they been involved in, do they have the experience and the knowledge to do the work that they are doing at the moment. Where you have financials, financial statements, it's important to do a full analysis of those financials. It's not so easy to get financials these days, of course. Does their business have an accountant, or do they rely on just doing their own bookkeeping? It's important to have an accountant and audit financials. And does the business require a license, such as a builder's license? Is it suspended? And is the business a member of an industry association? Some of you may have heard of the 5 C's of credit, and I'll quickly run through those. It's important to keep this in your mind when assessing any credit. The first 5 C's of credit is character. This is the impression the customer makes on you. You need to form an opinion. Do you think the customer will pay? Can they be relied on? And can they be trusted to pay their debts? Is there a history of broken promises? What is the debtor's attitude to creditors? Are they honest? Are they open? Are they arrogant towards you? And are they aggressive when they're questioned? Do they refuse or lack in wanting to give you information? You look at the senior managers and the business owners to see if they have a reputation for integrity in their dealings. Then you start looking at if the manager's been with the company long enough to have experience in one or more business cycles. Do they have the necessary experience and expertise in all the functions of the business? And does the company's success depend on one or more key managers? So they come under character. Next is capacity. Can the customer pay? Is there cash flow from the business to repay debts and trade purchases? Paid history with other credit relationships, with other suppliers. You need to assess the trade references, the credit checks. If it's an existing account, your own ledger experience. If necessary, ask for financial statements. Next one is capital. Capital is the money invested in the business. You need to assess what kind of risk the customer is willing to make to ensure their business succeeds. So again, check financial statements if you have them. But it's all about what risk the customer, what money they are prepared to put into the company. Collateral, that's personal and business assets that a customer is willing to put up as security in the event the business cannot repay its debt. Guarantees. You need to check real estate holdings, do property searches, determine what securities the business or the directors have given. A major effect on a business can be the conditions, the economy, conditions within a customer's industry. What conditions affect other businesses the customers deal with? Will it have a domino effect on their own business? Is the customer in a highly competitive industry? Does he have to offer low margins, tight margins? Is he in an industry where he'll be affected by seasonal factors? Is his cash flow very tight at some stages of the year and he needs to allow for this during the peak periods? What are the risks faced by all firms in this industry? You need to assess the industry and performance of competitors. You need to have an understanding of the industry. Good management will have adequate strategies for dealing with those risks. Does the applicant or your debtor have those strategies? How does the firm compare to other companies, businesses and industries? Are they one of the larger players or a smaller player? Are they new to the market? You need to assess their share of the market, their sales, profits and assets if you can do so. And the operations, how mature are the business operations? Is there still room for growth or are they at the end of their cycle? And how diversified is the organisation's product line and markets? Can they diversify out into other areas when certain product lines and markets become quieter for them? Another area I wish to touch on is financial analysis. If financials are available, they are definitely worthwhile, but aren't the be all and end all of, but they are certainly something to take into consideration. So the first thing you would do, or one of the many things you would do with financial analysis, is check the net worth of the position, in particular the tangible net worth. What are they really worth if you were to take goodwill out of the equation? You need to make sure the company is very liquid. Ensure the company has good working capital. Check the bottom line. Are they making a profit or a loss? Have they been making profits and losses in previous years? Cash is king. Some of you may have heard that cash is king. Cash flow is critical to a business. A company may be profitable, but not have a sufficient cash flow to pay a debt. Check the size of goodwill, trade brands. It may be overstated. You should always try to obtain audited accounts where possible. Read any auditor's disclaimer and check the notes to the accounts for contingent liabilities and other factors. Obtain interim results where possible, or management accounts. Should always compare results and ratios to previous years. You should be looking for a trend. Is it a negative trend or hopefully a positive trend? Is there a heavy reliance on overdraft facilities for cash flow? A lack of generating cash from internal operations? A bank may withdraw their overdraft or their lending at any stage. Consider one-off write-downs, non-recurring gains. Have they sold a property, or have they sold some plant, or have they written down a one-off expense? And be aware of intercompany loans, director loans, and drawings. And check additions of unaudited accounts. A number of times I've seen accounts that have just been prepared by the bookkeeper, and the additions don't actually add up. Once you've gone through all your credit checking processes, got all your credit reports from the credit reporting bodies, done your trade references, considered all factors, if you still have any concerns with the debtor, the new applicant, impose an initial cash sale, only trading period till they have started paying you. Set payment terms at 7 or 14 days instead of 30 days. Set a lower credit limit subject to review after a period of acceptable trade. You should always insist on personal guarantees and be prepared to apply interest on overdue amounts, which you would state in your terms and conditions. You can consider offering attractive credit conditions and settlement discounts, but that would be a last resort. And of course, consider trade credit insurance and take security, the guarantees, and make sure PPSR is registered. So you have your account established now, and if you've opened it up on a credit basis, you need to monitor it. It's a serious issue when debtors slow up in their payments to you, so you should be monitoring the account at all stages. Call clients periodically, maintain contact, build relationships with them. That helps if you're chasing their money and other people are chasing as well. Ensure your sales team advise you of anything they notice from visits. Very important. Same with other people that will go out and visit them. Ask for feedback. Maintain contact with other suppliers. When you do reviews, get new trade references. Network, go to trade bureaus, AICM, anywhere that is involved in credit, maintain contact and build networks. Regularly update your credit application form and seek updated trading conditions and details directly from the client. Keep an eye on from who the payments are actually received from. Are they still being received from the actual debtor? Resignation of a director, and you should be looking for a new guarantee to be completed. You should be also looking to get notifications, warning signs of any changes at ASIC. to which you need to investigate. I suggest you undertake quarterly or 6 monthly reviews of your major accounts, annual reviews of smaller accounts, but you should be at all times monitoring your higher debt, your major accounts through credit reporting agencies. I suggest all your accounts and through mercantile agencies. You need to have good follow-up procedures. You need to chase overdues early and conduct annual and interim reviews. You should be at all times making sure you are dealing with the correct legal entity. Make sure your organisation details for the debtor is correct. And where needed, obtain a new credit assessment process. So what are the warning signs? And there's numerous warning signs that you should be watching out for when an account starts deteriorating. Clearly, if an account starts exceeding their credit terms, that is a concern. Dishonest payments, insufficient funds. Where you see balances remaining on an account after payment has been made. Where they start asking to make instalments, or they start making payments in round sums. Where the amounts or the payments do not reconcile to specific invoices. I spoke about communication earlier. When they start communicating with you is a sign. When they start telling you lies, we'll pay you tomorrow, the check's in the post. Display of unnecessary aggression. You start seeing the signs. When they're subject to litigation, where they have an inability or reluctance or alleged difficulty in providing trade references to you or other information that you ask for. A lot of times you'll see an account where it's in trouble, the debtor will start raising disputes long after the product has been delivered to them and beyond the normal payment terms. So it starts forming a pattern and you need to take action. Media reports are important, and as I said, your sales team, any person that goes out and visits some information from them is important. If it's negative, again, you need to take action. Where they come applying for more credit without good reason, where they start swapping banks or attempt to swap banks, you can see that on a credit check where they might be making credit applications to other banks. Poor relationships with the bank, their current bank, inability to borrow further funds puts a strain on their cash flow and their liquidity. Where they have extended terms with suppliers, and as soon as they start factoring debtors and invoice discounting, it could be a reason, a negative reason beyond that. Other warning signs include where they have inappropriate pricing, their margins are too low, and their lack of market knowledge, not skilled in their market or their industry. Where they lose a major customer or they have over-reliance on one customer. I've seen many companies fall over because they've had all their eggs in the one basket. An inability to raise further equity capital, particularly with the larger companies, is a real concern. Many of the listed companies have fallen over just because they haven't had enough equity in the company. A real concern is when management is in dispute, particularly with partnerships, small companies, marital problems. Management lacks expertise and supervisory skills, and particularly with small companies and partners and sole traders, if there's an illness or death of key personnel or the owner or director. Where you can see a lack of management succession, inadequate generation change. Many times I've seen where a company's or business has been successful, but it's been handed down to the children and they have made a mess of it. Change in the emphasis of the business or a period of rapid expansion. You would have all heard about companies growing too big too quickly. It can be a concern, so keep an eye on it. Where their productivity declines or the quality of their product falls away or the service capacity declines, they are other concerns. Another obvious concern is where they have non-payment. They are deferment of their taxes, go on repayment plans with the tax office, non-lodgement of BAS. All these deferment of taxes or non-payments is a real concern. Your salespeople may come back and tell you that they're seeing a high staff turnover out at a business. They might be able to see that there's poor staff morale. There are other factors that are a warning sign. Inadequate financial information. If that you ask for financials and they're not prepared to give them to you, or they're very badly prepared, or they look like they've been adjusted, or if they've been making continual losses, their liquidity is low, their working capital is low, they have low equity position, have a look at all that. They are warning signs. Some companies or businesses have used creative accounting procedures. Just be aware of that. They will try to disguise poor results. And your sales or service people will come back and tell you where they start seeing aging machinery, or you can see that the business is not able to invest in the maintenance or replacement of their machinery or plant. And another warning sign is if a business is in an industry where new technology is outdating the products they have. There are numerous warning signs, but the main thing I wish to say is that you should always be monitoring an account, looking out for the warning signs. You should undertake a thorough credit assessment. It is important to know the legal entity you are trading with. You need to know who you would sue if they stop making payment. You need properly drawn up credit application documents, guarantees, terms and conditions. But I can only tell you, make sure you know who you are trading with and have a good credit policy in place and good training procedures for your staff. Stay in touch with other bureaus and attend those, and always keep on top of your accounts. So Terry, back to you.
Financials have been done or completed, the company fails, the work in progress has no relevance at all. Very hard to go back 9 months and argue with a business or accounting that that work in progress number was inaccurate. I've seen businesses just make the work in progress a figure that they require to get the correct profit result. Trevor touched on knowing your customers. Well, I think we're all too busy to catch up regularly with all our clients, but certainly the major customers, you do need to talk to them to understand them and get a feel for them. And if you can't, then your reps must recognize that they are your ears and eyes. They can usually tell whether a builder is organized on the job, whether the subbies are complaining about them being idiots or not getting paid or things of that nature. So if you can't do it yourself, then your sales reps should be keeping their ear to the ground and providing that feedback. I know when I used to go and catch up with construction companies, whether that was commercial or residential, I used to walk in through the reception area to go and have a meeting with a builder or director of a building company, and I'd take particular attention as to how many people were around in the office. Questions I used to ask, quite often builders won't provide you with the financials unless you're in a nice position in terms of your market dominance or the reliance upon your business. But I used to try and come out with an idea of how many homes per month they were building, for example, how many permanent staff they had, primarily head office staff, who weren't contractors. So contractors are different. If they don't have a house to build, then obviously they're not paying for the contractor, but we're talking about here permanent staff. What was the average contract size of their homes? So is most of the construction costing them $250,000 a house on average? Or at the top end of the market, are they looking at houses that are $500,000 on average to build. What's the average margin? You know, are they on average? Are they at the end of the job? Are they making 15%? Are they making 10%? And I used to be able to then go back to the office and work out if they're doing 10 houses a month and they've got 15 staff on permanent, and they say that their average contract size of the homes is $300,000, and their average margin that they're getting is 15%. I used to be able to multiply the numbers together and then work out that if the permanent staff, if there were 15 permanent staff, for example, and I took an average of maybe $80,000 or $90,000 per staff member, whether or not I thought that they would actually be making any money. Now, a number of them that I went to see clearly, just on that calculation alone, could not be generating profits. And at that stage, I'd actually either insist on the full financials or reduce the exposure of the business I was in. But it's very important that the reps recognize their role as your eyes and ears if you can't get out to see them yourselves. Cash flow issues. When a building company has some issues paying your accounts, there are a couple of things that I used to do. I used to take a drive looking at the sites where we delivered the goods. There's always an address on the system somewhere where the goods being delivered to, and a quick drive-by will tell you whether or not there's actually work being done on the job. Your goods may have been delivered, might have been a timber frame, for example, or frame and trusses. They've all been delivered, they're up on the site, but there's no other workers there. There's no indication that there are further deliveries or activity. So that used to create some warning bells for me, and I'd look to try and find other jobs that maybe we hadn't delivered. And if you go to half a dozen jobs and you find that there's no activity, then obviously that in itself causes some concerns for you to look deeper into it. Another area that I found was interesting with companies that had cash flow issues was how many slabs have been completed. There's a number of building companies that have failed that I'm aware of, where I've been around to a few of the sites, and the slabs have been completed. I remember one guy who was the president of the Housing Industry Association in a certain state, and they had some cash flow issues. And I went around to a number of their sites, and I think I went to about 12 sites, and about 10 of those sites purely had slabs completed. Now, as you probably know, if you're in building construction, the one progress payment that you can get with the cost to get to that progress payment is considerably less than the draw that you can get. I can't remember what the percentages are now, it's a long time ago, but if you say that it's 30% of the contract price is on the first draw, which is completion of the slab, and let's say it's a $200,000 house, if it's 30%, that's a $60,000 progress payment. And if the slab costs $30,000, my numbers are out of date, but when I was looking at it, there was a substantial amount of equity, and the difference in that progress draw against the cost of materials meant that the builder had a sudden boost to their cash flow. So if you think about 10 slabs, and if you can get an extra 25,000 or something like that from each of your slabs, as opposed to what it's costing you, 10 times $20,000, $30,000, it's a sizable kick into the cash flow. So those are a couple of things that I used to look out for in building construction. But quite often when building companies go broke, afterwards you hear stories about them being disorganized on site, or they order the same stuff twice, or they didn't order for the goods to be there when they organized for the workers to be there to do the work. So a disorganized builder, in my experience, is a good indicator that they're not going to be as profitable as what they hope. So I'll just go on to, and I don't want to go into too much detail about credit insurance, but hopefully you all know via either TABMA scheme, the TABMA credit insurance scheme, or other credit insurance involvement. But a simple fact with credit managers and providers of credit is that nobody trades with somebody that they think is going to go broke. Now, I was just sent an email this morning to David at TABMA to tell him that NCI this month have actually had their largest number of claims, or the month of May, the largest number of claims we've ever had. We lodged 202 claims this month. And each one of those, I would believe it's safe to say, wouldn't have conducted business if any one of them thought that they weren't going to get paid and the company was going to go broke. So it's like all insurance, it's about something that sits behind. But there's also a lot of things with credit insurance that people don't understand and think it's just about the credit assessment, but there's really more to it than that. So as the slide says, it's like any insurance. It's for cover against the unforeseen. Building construction is a major user of credit insurance. Most insolvencies would be in building construction. Size of exposures, whether or not you have credit insurance or you don't have credit insurance, I think one of the things that I always use a guide is what your individual exposure is to an individual customer. So if you're a $20 million business and your largest customer owes you 40, 50 grand, then I question whether or not you actually needed credit insurance. If you have good systems and good credit management, then if you lost a $40 or $50,000 account, well, if you're turning over that sort of money, then you should be able to wear it. But unfortunately, in building construction, it's expensive. They're expensive products. If a set of trusses is costing you 20 grand or 25 grand these days, and somebody's doing 5 or 6 houses a month or whatever, and then you've got timber and possibly hardware and other things, some of those exposures can be very sizable. What credit insurance can also deliver that a lot of people don't realize is it can grow the business substantially. So we have clients that say that with the support of credit insurance, allowing them to go into new markets, new areas, deal with project builders or unit developers or whoever, places that they weren't previously comfortable going into, having an insurer stick behind you and say, well, if it all goes wrong, we're going to cover you for $300,000 or $400,000 or $1 million in some cases. So it is very much about growing your business. We've had building construction people come to us and say, we just want to renew the policy. We don't care how much it costs. We grew our business last year by 40%, and we did it because we had the comfort of credit insurance. That doesn't mean that we would support the business of dealing with people that you think are very high risk or are likely to go broke or anything like that. Prudent credit management will always prevail and will always be the basics, but things happen, and managing risk requires taking a bit of a gamble at the best of times. Financiers like it. So we have some people that buy credit insurance because they're looking to acquire other businesses or they want to build a new factory or whatever. The fact is that banks and financiers like to have receivables secured, take some comfort from that, and will increase, or will often increase, the level of funding that you can obtain because you securitize your receivables. So whereas in the past they may look at your receivables, might be sitting at $1 million and say, we'll allow for our calculations receivables of only 400 because we don't know whether or not all that receivables is going to get paid. When it's securitized with credit insurance, they'll often say, well, okay, well, we know it's securitized, so we will actually allow 800,000 of that $1 million for our calculations on how much we can lend. And some of our clients have actually asked the funders to reduce their bank overdraft rates on the basis that they're a better risk, and they've actually increased the bank's security. It's not a generalism. Some banks will, or some bank branches or bank managers will arrange that, or will take that on board, and some won't, but it's not a general banking policy. True cost of credit insurance. Well, I guess selling credit insurance, one of the main objections is credit insurance is too expensive or whatever, which when you see the claims going through, I tend to disagree with that. But we have customers who tell us that really, regardless of the price and whether or not they ever make any claims, they regard the credit insurance cost as being either zero or not a true cost. Of course, they've got to fund it. Of course, they've got to find the money for it. But we've got some customers that say to us, we've sold an extra however much in the millions to customers that we wouldn't have been comfortable, or risk we wouldn't have taken on without the credit insurance. The margins on those transactions are somewhere between 10 and 20%, and the cost of the credit insurance is, in general, less than 0.5%. So I guess, yes, there's a cost of credit insurance, but it's not just always about the cost. There are other factors that come into play, and we've got some customers who claim by the time they factor in that profit margin of extra sales, it actually doesn't cost them a cent. So with that, we'll open it up for questions. I've lost the chats on, I've got it back again, on my screen. I can't see any on my screen, but the webinar is being conducted from Adelaide, so maybe there's some down there. So if you have any questions, put it in the chat. And Trevor, if you're still there, maybe you're getting any chat questions down there.
Okay.
Are there any questions? No?
No.
Okay.
The only question we had was we didn't hear the last bit, but that was quite a while ago from David Little.
Yeah. Oh, right. Okay. Okay. All right. Well, with that, we'll conclude. In 2 weeks' time, on the 4th of June at the same time, we'll have Jeff George, Head of NCI Compliance and Claims, and we'll be covering off the issues of collection of monies, innovative collection systems or new collection systems, phoning before the due date or after the due date, and Jeff will cover off the issue of preferences and what we can do there. So with that, thank you all for listening. I hope you got something out of today's webinar, and look forward to talking to you again in 2 weeks. Thank you.